Despite the challenges and uncertainties, the U.S. economy has shown remarkable resilience, and this trend is expected to continue into 2026. We're talking about a resilient consumer base and thriving corporations, which is a powerful combination for sustained economic growth. Let's dive into the key takeaways and explore the factors shaping this economic landscape. The job market, a balancing act. While the labor market has experienced a slowdown, there's a silver lining. Job creation is anticipated to pick up next year, driven by factors like potential Fed rate cuts, the impact of the One Big Beautiful Bill, and increased clarity on tariffs. Personal income tax cuts could also provide consumers with much-needed relief to manage rising prices. Corporate strength. Record margins. Companies are delivering exceptional results, with record margins across all sectors. This indicates a broadening of earnings participation, a clear sign of a healthy and non-recessionary corporate environment. Monetary policy, a stabilizing force. An easing cycle in monetary policy is likely to mitigate risks such as AI-induced disruptions, trade tensions, and private credit market stress. This approach aims to maintain the current expansion and keep the economy on track. Looking ahead, a smoother path. As we navigate the path to 2026, the U.S. economy is expected to maintain its resilience. The key question is whether this resilience can withstand the aftermath of the longest government shutdown in history. This is a critical theme that will shape the economic narrative in the coming year. In a recent interview, Jeff Schulz, head of economic and market strategy at ClearBridge, shared his insights on the key factors influencing the economy as we transition into 2026. The ClearBridge Recession Risk Dashboard, a green signal. Despite the government shutdown, alternative data sources indicate that consumer spending is stable and labor market trends remain intact. The dashboard's favorite indicator, initial jobless claims, remains at manageable levels, flashing a green expansionary signal. The odds of a recession in the next 12 months are estimated at around 30%. Labor market slowdown, a closer look. The slowdown in hiring is not a new phenomenon. The annual preliminary benchmark revisions to payrolls revealed a significant downward revision, suggesting a weaker job creation trend this year. However, factors like reduced labor demand due to tariff uncertainties and shifts in immigration patterns have contributed to this slowdown. Looking ahead, job creation is expected to rebound to around 80,000 to 90,000 per month, supported by Fed cuts, the fiscal impulse of the OBBB, and increased clarity on tariffs once the Supreme Court's decision on the EPA tariffs is announced. AI and labor markets. A complex relationship. AI has the potential to disrupt labor markets, but its impact is not as widespread as some may fear. While there are pockets of job losses in specific industries, the overall national picture shows no significant job losses attributed to AI. The unemployment rate for young adults aged 16 to 24 has increased, but this is not solely due to AI. Labor churn has decreased, impacting the job market for newcomers. Corporate health, profits and prospects. Third-quarter earnings results were impressive, with two-thirds of companies beating revenue forecasts. All sectors reported healthy results, indicating a broad participation in earnings growth. Corporate America is in a strong position, and the environment is decidedly non-recessionary. Fed policy, a cautious approach. The Federal Reserve's second interest rate cut in October was accompanied by Chairman Powell's cautious stance on further monetary action. The data will play a crucial role in determining the Fed's next steps. If the labor market remains stable but underlying inflation continues to rise, the case for additional rate cuts becomes more challenging. ClearBridge's view is that the Fed will cut rates less frequently due to a higher neutral rate than commonly understood. However, there is potential for 2 additional rate cuts by the end of 2026. Inflation. A persistent threat? Inflation risks are not fully under control. Companies have managed to mitigate the impact of tariffs by stocking up on inventory or absorbing price pressures. However, the January effect, where companies set prices around year-end, could lead to larger than normal price increases in 2026. The outlook for consumers is positive, with larger than typical tax refunds expected next year due to recent tax changes under the OBBB. Conclusion: resilience and optimism. The U.S. economy has consistently exceeded expectations over the last 5 years, and this resilience is expected to continue. While risks such as private credit buildup, AI-induced disruptions, resurgent inflation, and trade tensions remain, fiscal stimulus, a solid corporate sector, and a resilient consumer base provide a strong foundation for economic growth. The ClearBridge Recession Risk Dashboard and Anatomy of a Recession program offer a comprehensive understanding of the likelihood of a U.S. recession. This proprietary risk dashboard is updated monthly and provides valuable insights to guide investment decisions. For more information, visit https://www.clearbridgeinvestments.com/learn/anatomy-of-a-recession/question mark UTM source =livewire markets com UTM medium referral. This material is intended for informational purposes only and is suitable for wholesale/institutional clients, including investment professionals, qualified investors, and investment advisors. It is not suitable for retail investors and must not be distributed to retail clients. The information is general in nature and does not consider individual objectives, financial situations, or needs. It is not personal advice. References to specific securities are not recommendations. Investors should seek independent advice before making investment decisions. Past performance is not indicative of future results. Forecasts and forward-looking statements reflect ClearBridge's views and assumptions at the time of publication and are subject to change and uncertainty. Actual outcomes may differ materially. The distribution of this document may be subject to legal or regulatory restrictions in certain jurisdictions. It is provided for informational purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any securities, financial products, or services in any jurisdiction where such offer or solicitation would be unlawful. This document is intended for the recipient and may not be provided to other third parties without the express written approval of ClearBridge Star. Recipients are responsible for ensuring compliance with all applicable laws and regulations in their relevant jurisdiction. This document has been prepared by ClearBridge Investments Limited, ABN 84,119,339,052, AFSL number 307727, CIL, or ClearBridge Investments, LLC, ClearBridge US, as indicated and made available in Australia by CIL, Registered Office, Level 1335, Clarence Street, Sydney, New South Wales 2000, Australia. In the US, ClearBridge US and CIL's subsidiary, ClearBridge Investments, North America. Proprietary Ltd, ABN 11,138,069,191, China, are registered with the U.S. Securities and Exchange Commission as investment advisors under the Investment Advisors Act of 1940. Registration does not imply endorsement or approval by the SEC. In Ontario, China relies on the International Advisor Exemption under OSC Rule 35 to 502 to provide advisory services to permitted Canadian institutional clients without full registration. This exemption permits non-resident advisors to provide services to permitted clients in Ontario under specific conditions, including the absence of a physical place of business in the province. In Quebec, China relies on the International Advisor Exemption under NI 31-103, Section 8.26. which allows China to advise permitted clients in Quebec on foreign securities without Quebec registration. China is not registered in any other province in Canada. In the EMEA region, this document is intended solely for distribution to persons who are eligible counterparties or professional clients, as defined under applicable local regulations, e.g. MiFID II, FCA rules. ClearBridge is not authorized under local retail distribution rules, and this document is not intended for use by retail clients. It has not been reviewed or approved by any EMEA regulatory authority. This material has not been reviewed or approved by any regulatory authority in any jurisdiction. *ClearBridge refers to the global brand, ClearBridge Investments, which consists of ClearBridge Investments Limited and its subsidiary, ClearBridge Investments, LLC, ClearBridge Investment Management Limited, the ClearBridge Australian Equities Investment Team, a division of Franklin Templeton Australia Limited, and a part of Franklin Templeton Investments Corporation. All entities are wholly indirectly owned subsidiaries of Franklin Resources Incorporated, a publicly traded company listed on the New York Stock Exchange.